Hello, and welcome to In the Vault, A16Z's Fintech podcast, where we sit down with the most influential leaders in financial services. In these conversations, we offer a behind-the-scenes view of their experiences leading some of the most consequential companies. We dive into key trends impacting the industry, and of course, we discuss how AI will shape the future. Let's get started. Today, we're joined by Jeff Sloan. Jeff was most recently CEO of Global Payments. He joined as president in 2010 and grew revenues from $2 to $9 billion as CEO from 2013 to 2021. During his tenure, the company completed a $21 billion merger with TSYS and earned Fortune 500 status. Global Payments is now a $32 billion market cap company. In this conversation, Jeff and I discuss how he was early to spot significant industry trends, how to make bets that move a large organization, and of course, the sea change that AI represents for the financial services industry.
As a reminder, the content here is for informational purposes only. It should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security, and is not directed at any investors or potential investors in any A16Z fund. For more details, please see a16z.com/disclosures.
Jeff, we are thrilled to have you here.
Thanks for having me, Angela.
Excellent. All right, so I know this is a podcast, but I think it would be helpful if everyone in the audience visualized a background, which is really just the global payment stock price over the last 10 years. And then we can overlay when you joined. And so for those that haven't been looking up this stock chart like I have, it was flat, about $20 a share for about 15 years. You joined in 2010 as president, stays flat. 2013, you join as CEO. And then there's just this market rise all the way up to $220 a share peak in 21. And now Global Payments is a $35 billion market cap company. So congratulations. We're going to unpack specifically what you did to take Global Payments from, I think, $2 billion in revenue when you joined up to $9 billion in 2013. But I thought an interesting place to start, and what people might not know, is that you've had 3 corporate careers, and Global Payments was really your first operating role. So if you can maybe talk through journey of what you had before you started Global Payments, and then why did you specifically join when you did?
Well, thanks again, Angela, for having me. It's terrific to be with you today. So I've really had 3 careers. I started out as a lawyer, a corporate finance lawyer, for about 2.5 years. Then I went into banking, specifically investment banking in the early 90s. And then my third and most recent career was as an operating executive, as you say, over at Global Payments. That may sound like 3 wildly different things when you think about it. But the thing that I really found in common among all 3 was I really like change, dealing with change, and specifically I like, feeling uncomfortable. And I think the commonality of kind of switching careers a couple of times is I don't like to get kind of set in my ways. Once I feel like I've got kind of a firm footing, I really like to shake things up, feel stressed, feel comfortable being uncomfortable, is how I would phrase it. And I think it's worked pretty well over the last, kind of a third of a century that I've been working.
So you're making the change into Global Payments. Like, why Global Payments? Why at that time? Kind of what did you see that made you want to join that company and feel uncomfortable at that company versus somewhere else?
Global Payments really exists at the intersection of 2 of my favorite things: technology and financial services. And the thing I thought most about was what we could do really with the platform to modernize the technology, to grow the distribution footprint. A lot of the things that we ultimately did when I was running Global Payments from 2013 to 2023, a lot of things that we ultimately did were not even like a glint in my eye, back in 2009, 2010, when I was just thinking about coming over. But I was very confident in my knowledge of the people in the business, very confident in the quality of the platform. And I thought really it was the right platform on which to build a foundation of growth. And that's what I was really most focused on doing.
One of the interesting things we notice about CEOs that are able to scale really quickly is that they often sit at the intersection of a few different worlds and able to bring these trends together. And so people closest to you talk about part of your success was spotting trends and implementing them way earlier in an prescient kind of way. And so we're going to get to what those are. But maybe just to set the stage, so you join as CEO, can you, for those less familiar at Global Payments, like in 2010, 2013, like what were the business lines that you were in?
Yeah, so I would say back then it was probably primarily a business that was kind of legacy technology, kind of think IBM before Red Hat, or something like that, where it was a business that was data center kind of driven, legacy code. It existed, Global Payments and I, and this is also embarrassing to date myself. Global Payments and I are like exactly the same age. I think I was born like 1 week later in 56 plus years ago, almost 57, and Global Payments and I kind of shared more or less the same birth date, actually, within a week or so. But when you think about it that way, it was really kind of a legacy technology business on the technology side, coupled with good distribution or sales, of their products and services outside the United States, but really subscale and kind of immature in terms of diversity of distribution inside the United States. And I would say some of that I kind of recognized Angela externally, kind of having known the company for a really long time. And then some of it also, I kind of really came to the point of view about where we needed to invest and how aggressively when I came to the company in 2010 as the president and COO, and then 3.5 years later became the CEO. So during that period, we really started thinking, I really started thinking about, okay, what areas in both technology investing as well as distribution or sales do we really need to bolster to really take the company to the next level? Happily, that really happened at the same time that there were seismic changes going on in the software and technology world. Think about the ascendancy of the cloud in terms of technology environments. Think about during the middle of the last decade. Think also about the nature of how you procure digital kind of payments and services, e-com, being an obvious one. So there were a lot of seismic shifts going on, both as a technology matter and also in terms of the digitization of payments that really influenced where we thought, once I got there, where we thought we needed to make the investments.
You talk about the evolution of financial services into fintech, and I think the fintech term became very popular around actually when you became CEO. And my joke used to be that it was actually very much the same thing. It's just that it was done by really smart people wearing hoodies versus smart people wearing suits. So I'm picturing you putting on your hoodie and walking into Global Payments right now. But you touched on trend one, which I think is really obvious now, was much less obvious at the time, and that was that many companies don't actually want to buy payments. What they want to buy is software to operate their business, and then that would happen to come with payments. And I think it's obvious now. We've got companies like Toast, which is restaurant software that makes the majority of their money from financial services. You've got Service Titan, operating systems for plumbers and electricians, makes a lot of money from financial services. But 10 years ago, that was a lot less obvious. Do you want to talk about, like, how did you bring those things together and how did you go about executing on that?
I agree, and I'm not just saying this because I'm on the A16Z podcast, but I agree with Mark Andreessen. I mean, my view all along, once you've come to the point of view that your core skill set and asset is as a technology company, that really software is eating the world and is the mode of differentiation. It is how we win at the end of the day. Now, you don't have to own all that software. You can be a great partner with people who are very good at software, which we do. But by the time I left and retired last summer in 2023, we were actually a top quartile software company by revenue in terms of cloud SaaS. If we had been listed just in the public markets in the U.S. for cloud SaaS software at Global Payments. So clearly, I thought it was I think we were doing something like $3 billion of revenue a year in software sales. So clearly, I thought that was a huge mode of differentiation for what we were doing. I did take a lot of grief for that thesis because it was pretty controversial in the industry, particularly in the sell side and the buy side, 10 years ago. But my perspective, and one of the things I thought we did very well at Global Payments, my perspective is you have to be very close to your customers. We have to know what customers want. We have to get kind of instant feedback. And if we're doing the right thing, we need to scale it quickly. If we're doing the wrong thing, we need to fail fast. And that's one of the things I thought we were very good at Global Payments. And that's what gave me the confidence that going down the path of software based investment, was really the right thing to do. Today, it's kind of table stakes and dogma in our business. But I can tell you, I spent years telling people why, well before Toast, came public, well before Adyen, Stripe, Square, et cetera, were really on the scenes in public investors' minds. I spent a lot of time proselytizing as to why, this was the right thing to do. And I'm really happy that in hindsight, it worked out.
Actually, it's a good note. We have a lot of CEOs that'll be listening, scaling their companies, and one of the things we often think about is there's no bad ideas. There's only early ideas, and to your point, you were early and you took a lot of grief. Any advice in how you either kept your confidence through that time or recalibrated? Are you really right, and it's just a matter of time that you could perhaps help those listening think about?
Well, I think one of the most important characteristics for any CEO, but especially a technology company CEO, is putting a lot of bets on the table. In technology land, you generally don't know instantly that the technology you're investing in is going to be successful until you kind of see what the demand is. I'll just give you one real world example, which fills me with a lot of pride because it's actually kind of counter. It's like the exception that proves the rule. It's kind of counter to what I just said, which is in the sports and entertainment business, which changed substantially with COVID, but I think was changing anyway. We built really kick-ass software that we got to the point where I would walk into a meeting with large professional sports teams, and 15 minutes in, they would just say "sold," on the which very rare to happen, right? Kind of at the end of the day, and I felt it was a great tribute to the quality of the software, products, and services that we built. The same thing was true. One of the last deals I signed before I left was McDonald's. They just announced in their recent rollout of their new environment, which is the next generation of McDonald's. I was in that pitch too, kind of a year and a half ago, like when I was leaving. Same thing, 15, 20 minutes in, done, right? Sold. So I say that's the exception that proves the rule because it's very rare to be sitting in a meeting, with professional sports teams and McDonald's and have them tell you, hey, we're sold. But I would say, in a certain sense, what you're looking for is feedback, from your customers of, where their pain points are and what problems they're trying to solve at the end of the day. And I think it's our job as CEOs, and I think Global Payments historically had gotten into trouble here before I took over in 2013. I think it's our job as CEOs to put a lot of different bets on the table. Global Payments have really been rifle shot in terms of distribution before I came on board as CEO, and that worked for a period of time, and then it kind of stopped working. And then I think if you lose momentum in technology, if you lose momentum in sales, it's very hard, I think, to get that back. So part of my thesis really was putting bets in a bunch of areas. And like in tech land, it's going to take 18, 24 months for you to figure out, well, was that the right, kind of bet? Is this, how does this go? And the obvious, like, ultimate examples, what I said before, both in the sports area as well as in quick service restaurants, that's the exception rather than rule. But having said it, though, I do think at the end of the day, being close to your customers, getting that kind of feedback as to what problem they want solved, having them reaffirm that you're on the right path, I think is really invaluable to running any of these businesses.
Perfect segue. I think if you think of investing or company success as having like a product advantage and a distribution advantage, right? You came in first and you're like, let's create the product advantage, which is very much integrating payments with the vertical software. And now you're segueing to, great, now we also need a distribution advantage. And so I think it'd be helpful, like payments for the most part before it was sold through ISOs or independent sales organizations. And really over the years, you transferred that more towards software vendors. And so payments would be bundled and integrated with software. You've now got thousands of these software vendors that sell your solution, in the United States, around the world. Maybe, Heartland is the start of that transition, but talk through where you were when you started and what you're ultimately trying to get to on the distribution side.
My perspective all along, Angela, was I don't know what's going to win. I think it's important to have diversity of that distribution. What I really liked about the software stuff is we're selling a technology-based solution. We want our customers to be delighted with what we're selling. What better way than to sell it through a mission-critical vertical SaaS, which they're using to run the businesses. And we kind of run in the background, much like in Uber, the payments is kind of behind, and Uber Eats, the payments is kind of behind the wall and is in the background, and you just know it works. And that's kind of the vision, I had of that part of the business. And obviously that's evolved over time. But I think having the perspective of diversity of distribution, having a lot of different ways to sell is super important because it's very rarely the case that one mode of doing something, whether it's on the technology side or it's on the sales side. It's very rarely the case that there's one solution, you happened upon it, and that works, for all time. That's really just not the nature of how things are bought and sold. And I would say at the end of the day, to highlight the point about diversity of distribution. So by the time I left Global Payments last summer when I retired, we were selling stuff, consumer self-service, kind of online to small doctors' offices through our Advanced MD healthcare practice. We were selling with high physical touching into advanced quick service restaurant environments like a Burger King, or a McDonald's, which are highly customized IT kind of installs. We were selling through physical sales reps, which is kind of Heartland, physical kind of feet on the street. And we were selling through some of the largest, most sophisticated software partners, as well as our own software, into the most complicated as well as simple environments, on the planet. So it wasn't that we pivoted to something that just worked by itself like ISVs and kind of stopped. Instead, it was all part of the thesis of, hey, it's a mosaic of solutions. I don't really know what is going to be predominant, not just today, but 5 years from today. So it's important to have a lot of different bets in a lot of different areas. And if those are successful, which is what the feedback we're getting from the market, scale those quickly. So put more and more and more resource. And we were very much focused on measuring every month detailed ARR being generated by those software sales into those environments and throwing more resource at those things that we thought were more successful.
When you talk about multiple bets, is there a bet you made that didn't work that you can talk about?
Yeah, I would say less that didn't work, more like got derailed. So I think if you think obviously, about COVID and some of the changes, that came with COVID, like, look, everybody else in the world really, of course, didn't see that coming. So when that hit, we really had to as did probably almost every company, on the planet. But I would say we had to substantially, reposition the business. A great example of that is in the quick service restaurant space, we had on the drawing board. So we were not early, but probably on time in a pre-COVID environment, but late, as COVID. So this was obviously a miss, but we clearly caught up. When COVID hit, small and mid-sized restaurants very quickly, like a pizza chain or whatever, very quickly said, "Hey, I need the ability for customers to order this stuff kind of online, order on your phone, order from your iPad, whatever it is, have it integrated into DoorDash, Uber Eats, et cetera, and have it all be seamless." Well, we had that in the context of like a Burger King, in the context of like very large customers. And we called that service, that software, Omni is the name of it. So we had that in the context of very big guys, but clearly, like, we didn't know that was coming, and the ability to pour resource and scale on that is something we really had to play catch up on. So it was like on the drawing board, it was working, but the ability to take that from a very small portion of the business into being a primary means of distribution, we had to play a lot of catch up. Same thing was true in the medical software field. Like, we had a teledoc piece that we were using at Advanced MD in terms of software sales. And those sales were really done remotely through kind of Google web pages where docs would like click on that. We, consummate that sale via call centers, that kind of thing, and sell software that way. That's very different than setting up all these doctors on teledoc. So like we had a teledoc package, but it was tiny, not scalable, small, all the stuff you would envision if you weren't in a crisis environment. So very quickly we had to scale that too. So I would say, Angela's less of a miss and more of caught by surprise, kind of having things that were, on the drawing board as a product matter for investment, and all of a sudden having to drop everything, redirect the resource because the world had changed. And as I say, I think one of the things we were very good at was scaling quickly and kind of failing quickly. So, if things didn't work, we just kind of junked it and started something else. But ultimately, those two things, the remote delivery and the teledoc, are key parts of our business today and are generating, billions of dollars of volume years post-COVID.
So doing deals, I imagine, would come very naturally to you from your banking background. And then the clear difference when you're running a company is you do the deal, and then inevitably you have to figure out how to do the best form of integration, which I imagine is something that you've evolved a lot your thinking on over the years. Do you want to talk just tactically, what's the best in class deal integration that you think about at Global Payments?
I found what's most effective is really setting the tone at the top. So what I think tends to work in these things is setting up what we used to call an ESC, or an executive steering committee, which usually meant it involved me and a bunch of the other senior operating executives at the company. And, even if it was a small deal, the size of the deal really didn't matter. But at the end of the day, you might have 50 work streams from finance, accounting, sales, HR, legal, tech, of course, et cetera, on any given deal. So what you really needed was accountability and governance around structuring how the performance was moving ahead, probably for 12 and in some cases 18 to 24 months for bigger deals, but at least, the first 12 months after close, where are we really, kind of regardless of the deal. So we would meet as an executive team with people who are running the integrations, generally one person on the global side, one person on the counterparty side. We would meet monthly to get executive reports on kind of what was going on. It didn't really matter what the report said. I think the main thing was the practice and effort of making sure that everybody on the deal teams knew that we were, focused on it. We were going to kind of stick to our knitting and make sure that what we committed to, was going to get done. And years later, we would do postmortems, like how did it really go, kind of compared to what we did. But a lot of people, when they announce a deal, take a sigh of relief and say, hey, as an operating manager, hey, that was a lot of work. Hey, we're super busy. Time to move on. My view is like the work only starts really. It's easy to write a check. It's not so easy to operate a business with hundreds and thousands of people in it when you're trying to take the best of both companies, which was really generally our approach. So I think that was super important. By the way, that's super important for acquisitions, but also super important for divestitures. We sold businesses too, and it's the same thing. I think there's no substitute, for that kind of planning, integration, thinking ahead. And then even after the disposition is consummated, same thing. I think for months thereafter, it's super important that we have line of sight, know who's accountable, have governance, have control over how those businesses are reporting. We had a lot of data in our business, and I think using that data to your advantage in things like this is super important to success.
So a few years ago, and this was kickstarted maybe by a few of your competitors, some mega mergers, right? Like Fiserv bought First Data, FIS with WorldPay, and then Global Payments and TSYS. So it was 39 billion, 21 billion, 22 billion, big deals. I think you want to talk like versus the other deals, which position more as we're broadening our scope. I think Global Payments took the strategy as, we're very pure play payments. So maybe talk two things. One, obviously you believe in this scale advantage, and then two, why the strategy that you chose?
Yeah, I think technology is a scale investing business, at least in digitization of payments. And what do I mean by that? So I think the amount of investing within technology, so directionally that what I'll tell you is correct. So when I got to global payments, maybe we spent a couple, 300 million a year, OpEx and CapEx in tech. When I left last year in 2023, that number was north of 2 billion. So obviously there was a lot more revenue, there were a lot more people, there were a lot more customers, there were a lot more partners. But it's a lot better, for us to invest 2 billion a year in tech than it is for us to invest 300 million a year in tech. So I think at the end of the day, there are enormous scale economies. We had signed marquee and really distinctive deals with both AWS and Google in the last few years I was at the company. And I can tell you from having dealt with them, having dealt with other partners of ours, scale matters in that business. So I think the company last year did something like 75 billion transactions and probably processed something like $3 trillion plus or minus, a volume. Every transaction incrementally needs to come in at a higher margin than the last transaction. And we need to continue to grow and do more to get our margins up, to be able to afford to make the investments we need to maintain and accelerate our pace of cutting edge technologies, to remain competitive and get ahead of the competition. So I think at the end of the day, it's important to have that flexibility, that capability to make the investments, organic and inorganic, in our environments that we need to make. And it's very hard to do that without scale.
Well, and then I think also to your point, right? If Global Payments was more on the acquiring side, with the TSYS merger, you get the issuing side. You're trying to provide more to your software customers.
That's right.
It just enables you to bring a more holistic solution to the market.
I think that's exactly right.
So let's maybe shift gears a little bit and talk what's coming up forward, right? Like you have run, pretty comprehensive playbook on the consumer side. I think right sort of close to before you left, you started really almost looking seemingly running a similar playbook in the B2B side. And B2B payments are still, more than 25% cash and check. There's a lot of room. So maybe talk a little bit. How do you think about that market? What's the same? What's different? Would the same strategy kind of work?
My perspective is that investing in B2B technology today has the same growth opportunities, if not more so, than investing in e-commerce did, kind of at the end of the last century, is kind of my view. The size of the market, I think MasterCard's pegged it at $125 trillion annually, which is 4 times the size of the consumer-driven B2B2C market, where global payments historically had competed. And you're right in what you said. Roughly half that business today is still kind of cash and check, right? The other half is ACH or some other, some kind of other variant. So listen, half of 125 trillion is a big number, right? At the end of the day. And of course, there's the ACH piece too, which, I think that business is changing as well. So my perspective is fantastic growth opportunity. No one really has a meaningful leg up on anybody else. It's wildly diffuse, massively underpenetrated, a gigantic market as it relates to target addressable size.
We're right now in the middle of one of the largest technology platform shifts with generative AI. Like, how did you think about it at Global Payments? How did you help, where do you see this potentially impacting your business?
Well, I think it's going to be an enormous sea change, not just for global, but really for a lot of our customers. I mean, think about traditional financial institutions, particularly for TSYS on the issuing card side. Think about how that's going to change customer service and how customer service and chat and those kind of features and functionalities, how those things will be rolled out over time. So instead of you calling the call center, speaking to a human, and all these other things, a lot of that stuff is going to be done automatically, I think, through generative AI. A lot of the underwriting, the AML, the KYC, all those things, I think can be automated much faster, cheaper, better margin, better responsiveness. And I think it frees up, human beings to focus on additional value-added services and makes them more important in terms of what they need to do and really ups the skill set. But there's a certain amount of administrative side, which I think can be dealt with, through generative AI. So I think it's going to pretty substantially transform the margin characteristics of what the business really is and can be, and I think can really augment, therefore, the opportunity for technology people in the business to focus on what they think is most important. Of course, the corollary to this, and you've seen this already, is the deep fakes and the stuff that comes out on the fraud related side. But I think that's also a great opportunity for global payments and people in the industry to come up with better AI protocols that actually stop, the deep fakes and the fraud coming from, generative AI. So I actually think it's really a seminal event in our business, in fintech, in financial services, and is another reason I'm so optimistic, about the rates of growth that you'll see in the business. And yes, margin's a big piece of that, but I think the products and services that will be developed to both address the pros and the cons of generative AI, I think are super exciting.
100%. And next year's podcast is going to be run by the Angela Strange AI avatar. So coming.
Right.
Jeff, this has been great. One of my takeaways here is, lots of bets, listen to the customer, double down on what's working. As you think back, to yourself 10 years ago, or just in general, what do you wish you knew then that you've learned, or any advice to CEOs that aspire to have the revenue growth that, Global Payments has had over the last decade?
Yeah, I think, just to talk about one of the things I don't think I did well, which I think falls into the advice category, is look, it's a marathon, not a sprint. And I think it's very easy, particularly in stressful environments, to get carried away too far one way or the other. A great example for me individually and also for us as a company was Brexit. So we have a pretty meaningful global payments business in the UK. At one point, it was probably 3 to 5%, something like that, of revenue. And we were very focused and hopeful that Brexit would not be voted in favor of Brexit, and we were disappointed, obviously, when it will. And we're not the only people, obviously, who felt that way, but we didn't. We're obviously not there. It's not our vote. But I would say that I kind of felt like I knee-jerked too quickly. Like, we had a bunch of investments we were making, technology investments as well as distribution investments, in the UK. which when the Brexit vote happened and it started to get implemented pretty early on, I'm going to lose track of the years here, but probably in 18 or 19, we cut some of the investments that we were planning to make in the UK, not in Europe, but really in the UK. And I think that was a mistake. I probably should have gone more slowly with that and said, you know what, this thing can change, things can happen. I mean, no one could really foresee the COVID situation, but things can really get mixed up. Maybe it's not, the bad economic outcome, that it might be. Obviously, there was an economic cost to it, but maybe I've overthought that. And I think in hindsight, that was probably not the right thing to do. I probably should have been more patient and said, yes, this is a challenge, and yes, this is not good, and all these other things. But it's going to take a period of time to play out. We don't know what that's going to look like, so let's just take it one day at a time. And I think our business would have been better positioned, had we not cut those technology investments. So my advice, kind of coming out of like that war story is, look, there are going to be things that happen you can't control. I think we all know that. That's just the nature, I think, of life, particularly in any kind of complicated business. But I think it's super important, though, to take the long view and to say, look, there's a lot we don't know. Let's see what happens. We don't have to decide today. But, you're in an environment where you don't have unlimited resources. So you're trying to do the best with what you have. And it's not like we did those things and then didn't do anything. I'm sure we reallocated those to other businesses, those investments. But I think moving too quickly like that was probably a mistake. I've always felt that way. And I think I should have taken a deep breath, kind of at the time and said, well, let's just see how this plays out.
Jeff, thank you for joining us. Really, really appreciate your wisdom, and congratulations on all you've accomplished.
It's my pleasure. Thanks for having me, Angela.
I'd like to thank Jeff Sloan for joining In the Vault. You can hear all our episodes by going to a16z.com/podcasts. To learn more about the latest in fintech news, be sure to visit a16z.com/fintech and subscribe to our monthly fintech newsletter. Thank you for tuning in.